I think the RBA has actually, for the first time, made a bit of a panic decision. Jordan Eliseo, ABC Bullion. The government budget stated that Australian economic growth is faster than all major advanced economies. However, the latest GDP data for Q1 of 2016 came in well below market expectations and showed deflation. Do you believe Australian economic growth is as strong as the government seems to believe?
GDP is, at best, a questionable way of measuring the health of an economy and how well it's performing and how well individuals within the economy are actually travelling. So GDP growth in Australia has been, for want of a better term, propped up for the last few years by two major trends. The first of those has been very, very substantial increase in immigration. And the second of those is the impact of net exports. So we've seen enormous increases in the volume of our key commodity exports, even though the price that we're being paid for those exports has actually declined substantially. If you were to look at what I think are more relevant indicators like real wage growth or GDP growth per capita, you'll find that the Australian economic story is far weaker than what the headline GDP number would indicate. Now, that doesn't mean that the government is completely out of line or completely wrong to make the statement that they are. Australia is still performing much better than many parts of Europe and Japan and even the US is starting to slow down as well. But the key takeaway is when we scratch underneath the surface, the Australian economy is struggling much like the majority of the developed world.
Australia is currently trying to move away from the mining industry and into other areas such as tourism and hospitality. However, the government believes that exports, household spendings and investment in housing are the driving forces for the Australian economy. Again, looking at GDP, the last quarter of 2015, while showing growth, was much slower than previous months, and investment in housing fell and net exports gave no contribution to the GDP growth. Although the budget outlined there have been new trade deals formed with China, Japan and Korea, do you think it is sensible for the government to base so much on its exports industry?
Look, I think Australia's had a very solid export industry, obviously predominantly commodity driven for really the last 15 odd years, and that's been a good thing. Well, of course, we've still been running current account deficits and the like. The problem that we've got now is that whilst there is still substantial, or there has been substantial export growth, the more important factor is the price we're getting paid for those exports, which, as I say, has declined quite substantially already and in all likelihood has further declines to go. Look, for the economy to be genuinely healthy, there needs to be a positive blend or a blend of domestic demand as well as exports. The challenge that we've got is that the government in and of itself is already running quite substantial deficits, so there's not much more they can do on the fiscal side. Business investment in Australia, not just in mining, but outside of mining, housing and the like, is basically rolling over and is set to decline as well. And of course, households are now in a situation where they have never been more indebted and where they're facing effectively zero to negative real wage growth. So there's not much that they can do to stimulate demand either. So I don't think it's so much or necessarily just a problem with what the government is trying to do. It's just a reflection on where Australia is at as an economy. And that's not surprising after 25 years of uninterrupted economic growth. We were always going to hit a difficult period, and that period is now.
The government announced in the budget that it is sticking to its National Economic Plan for Jobs and Growth, stating that almost 300,000 jobs were created last year, the largest amount in a single year since 2007. This is backed by figures from the latest release of unemployment data, which posted better than expected results, with unemployment decreasing to the seasonally adjusted rate of 5.7% in March. However, the quality of the jobs was brought into question, with concerns of people being underemployed instead of unemployed. Do you believe the job force is as strong as the government seems to think?
I think that the point you made regarding the quality of jobs is a highly relevant one. We are now in a situation where unemployment has, at a headline level, been declining, although I would note it is still higher than where it hit when the GFC struck sort of several years ago. So it's a long way from looking rosy, even at a headline level. More importantly, though, is the issue of the quality of the jobs. A lot of underemployed people, and that's reflected in as I say, the sort of flat to negative real wage growth. It's also very clearly seen if we look at factors like youth unemployment, which has risen from less than or lower than 8 to well over 12% now, showing how hard it is for new entrants to the labour force, even those that have gone on to university and got higher qualifications, how hard they're finding it to gain meaningful employment. So again, whilst the headline number doesn't look too bad, and certainly if you were to compare it to parts of Europe, it would be a much better result here than what we're seeing in certain places overseas, there are problems with the quality of jobs, and again, that is reflective of a trend we've seen in the post-GFC period in places like Europe and indeed even in the United States, where we've seen a huge decline in high-paying jobs and an increase in lower-paying, more temporary work. So, whilst the headline unemployment rates are looking better and better, the real story under the surface is still very troubling.
The RBA cut its official cash rate by 25 basis points to a historic low of 1.75%, citing the unexpectedly weak inflation data for the cut. The Australian dollar reacted immediately, dropping 1% against the US dollar. How do you think this decision will affect the Australian currency in the long term?
Firstly, I think the first point to make is that I think the RBA has actually for the first time probably made a bit of a panicked decision yesterday. I was very surprised to see them cut. I've been forecasting lower interest rates for a long time, but I was surprised to see them cut yesterday on budget day. I thought they would wait until at least June or potentially July. I think the decision to cut in the face of one, troublingly low inflation print was a mistake. I also think that in an environment where real wage growth is as I say, negative or flat to negative, the fact that inflation is low is actually a good thing for everyday Australians. The idea that we would want inflation to rise and that we would want the value of our money to decline at a faster rate, it doesn't make any kind of common sense or to myself at all. As for the implications for the Australian dollar, look, the market had already been forecasting some kind of interest rate cut between now and the end of the year anyway. But what I think will happen now is that the RBA will cut to at least 1.5%, if not 1.25% by Christmas 2016. And we're likely to see the Aussie dollar head back toward or even below 70 cents versus the US dollar.
Thank you, Jordan Eliseo. That's all for today. I'm Celeste Skinner, and tune in tomorrow with Jessica Walker. Goodbye.